Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken and our model portfolio is up 12.94% year to date. Here, our goal at Spy Trader Now is to beat the returns of the S&P 500 buy and hold investor. And we do this with investment grade capital as opposed to trading capital. Right now, we are trailing behind the buy and hold investor by 2% for this calendar year. Usually, we are farther ahead than this, but this has been a tough trading year with the strategy that we impose here at Spy Trader Now. Here are some past returns for Spy Trader Now. You see the last 3 years have been pretty good years. Last week, the S&P 500 gained 1.36% for the week. We are going to go through the charts in much greater detail later on in the presentation, but I want to point out right now on the weekly chart, you can see this downward sloping, which once was acting as a resistance line. Once we got up above it and closed above it, this is now going to act as support. I do have an expectation that we are going to come down, kiss this support line, and then advance. That is my expectation, but that may or may not come true. You'll see later on in the presentation why I believe this. So that is what I'm expecting. Last week, we made no trades in our account. Here are some trades that I've made for calendar year 2023. If you want to see all my trades going back for 3 years, head over to spytradernow.com. There'll be a link down below in the description. And I have 2 open trades right now. And that's why these 2 cells are highlighted with yellow, because they're still open trades. They're not closed out yet. That's why they don't have the sell date filled in yet. And if you want to see exactly how I go through this portfolio, go ahead and hit that subscribe button. Ring that bell to be notified when I post a new video. And help me by smashing that like button down for me. Thank you. Here is the equity curve of our model portfolio for 2023 year to date. You can see that 2 weeks ago we had the best week that we've had ever. And so we were lucky enough to experience that profit that the S&P 500 also experienced during that week. Here's the equity curve for the S&P 500 buy and hold investor for 2023. And here are the 2 equity curves combined on a percentage basis, because we need to compare our portfolio against the benchmark of the buy and hold investor of the S&P 500. You can see that the model portfolio is slow and steady. Yes, it did have a little dip here, and we did have a couple weeks of a dip here and a dip here. But overall, when you do a comparison basis, we're a lot steadier and smoother going up than this portfolio, the buy and hold investor. Here is the Fed chair, Jerome Powell. Here are some of the interest rate movements he's made in 2022 and 2023, most of them actually. Now, the last announcement on November 1st was a Fed skip rate hike, which he's done now for 2 consecutive meetings. The next announcement will be on December 13th. It is unclear right now whether we'll have another skip or we'll do a 25 basis point rate hike. Now we are looking at things from the presidential election cycle theory, which states, depending upon the year of the election, you have historical rates of return for the S&P 500 and down below here for the NASDAQ 100 symbol QQQ. Currently, President Biden is in his 3rd year of his election cycle. Historically, the S&P 500 has averaged a 16.3% return for the 3rd year. Currently, the S&P buy and hold investor is up about 15%. So they're within 2% of this historical average. Now we are looking at things from the bond market outlook. And the bond market is saying to stay out of the stock market because we have an inverted yield curve and we have rising interest rates. Now, what's interesting, 2 weeks ago, we were starting to watch how the yield curve was getting closer to parity, and I thought that that trajectory was going to continue, but that trajectory changed this week. We're getting farther away from parity right now. So that it indicates that the yield curve inversion is going to continue for longer. And we can't really have a normal stock market till we have a normal yield curve. You can't have a good bull stock market until this happens. So with this inverted yield curve, the threat of us having a really poor bear market in the stock market is definitely something to consider. Now, one other thing you want to consider, when the yield curve does revert back to a normal yield curve, then the stock market usually experiences its bear market 1 to 4 months after normalization. So probably sometime in 2024, we're going to have a turbulent 2024. Now we are looking at things from a valuation standpoint. According to CMV, current market valuation, link here and in the description down below, we are overvalued by 39.3% on a price per earnings ratio going back for the last, going back, I think, 10 years. So the current S&P 500 10-year PE ratio is normally 28.1. So that puts us 39% above the modern market average, which is normally 20.2. So we're definitely got high elevations in the current market. Now we are looking at CNN Business Fear and Greed Index. Here is our friend Warren Buffett, and currently we reside at 42, last week 39, so we are definitely in fear. But when you see the VIX, you'll see how low the VIX is. This is going to continually go this way because the fear is definitely coming off of in this market. We're definitely going towards greed rather than fear in the current environment. Now we are looking at things from a seasonality outlook, which states, it doesn't state anything, but what you look at here is on a seasonality graph going back for 20 years. In the month of November, the current month, there's an 80% probability that the S&P 500 will close higher, because that's a symbol I have in here, than when it opened. And we've already accomplished that. For the month of November 2023, the S&P 500 is up 5.36%. Look at this very large green candle. So we could absolutely come down a lot and still have a positive month, maintaining that 80% probability baked into the cake on a seasonality basis. Now we are looking at things from a long-term outlook. This is a monthly chart, S&P 500 going back 20 years. Bull run 2009 all the way to 2022. Then downward correction, then broke out above this line right here. And since we broke out above that line, we are in a long-term bull market as long as we stay above this line and this line, and we are currently doing that. The monthly has come down into our moving averages, bounced, and has gone up. And if we continue this trajectory and go sideways and then eventually come up from there, we're going to maintain this long-term bull run. MACD was coming down towards its signal line, never crossed it, and it looks like it's going to go parallel and then go up. That's bullish, long-term bullishness. Now we are looking at things from an intermediate term outlook. Weekly chart going back 5 years of data. These candlesticks represent 1 week's worth of data. And this is the same chart I showed you earlier in the presentation. We've broken out above it, and as long as we stay above here, we're looking good to go long. Don't go short this market. As long as we stay above this line, we need to be going long this market. So currently my portfolio is positioned with 2 in the money covered calls. if my expectation is right and we come down, kiss this support line, I'm going to buy to close my in the money calls, and I'll put on some more long calls to take advantage of that next run while holding my 200 shares of SPY. The MACD has bottomed. You can see the histogram, it's going up, and it looks like it wants to go up and cross above its signal line. Now we are looking at a short-term outlook. These are daily candlesticks. You can see them really well on this chart. This is 6 months worth of data, and you can see here how we came up. I thought we were going to come back down. That never happened. Only on Friday. Friday was the only day that this happened. We were right up against this resistance line, which was showing you previous resistance earlier on here, all throughout. And what happened was, instead of it acting as resistance, we punched through it. So there was resistance there, but the market persevered. The bullishness persevered, and there was this downward trajectory. So we overcame two trend lines, two resistance trend lines last week, and all of it happened on Friday. Now we are looking at a ratio chart for the NASDAQ 100 against the S&P 500. The ratio chart is in red and black. S&P 500 is in blue. The NASDAQ 100 is lime green. This chart, the way that it is positioned, is bullish. So this is all bullish action that's happening here. And I drew in a line here to represent this top of the ratio chart here and here, and we broke out above that as well this week. So all this is saying bullishness is in the future for the stock market. Now we're looking at another ratio chart, but this time it's the equally weighted S&P 500 compared to the normally weighted S&P, cap weighted S&P 500. The ratio chart is again in black and red. The normally weighted, cap weighted S&P 500 in blue, and the equally weighted S&P 500 is in green. Now during the nice bull run, 2009 going up here to 2020, you can see that the equally weighted actually surpasses the normally weighted. Keep in mind that the equally weighted equally weights 500 of the stocks in the S&P 500, whereas the normally cap weighted puts a majority of the weighting on the top 10 holdings. So you have much less participation when the normally weighted S&P 500 exceeds the equally weighted S&P 500. Now look what's happened here. In the thumbnail, you'll see how the normally cap weighted S&P 500 completely surpassed the equally weighted S&P 500. So the market did go up, but it went up with fewer names than the equally weighted. So there's less participation. If those 10 holdings that have a majority of the weighting of the normally weighted S&P 500 start to give up the ghost, this market can turn around very, very quickly. Oh, God. All right. Hold on. Now on this equally weighted chart, the ratio chart has fallen off of a cliff 3 times in the last 20 years, followed by the S&P 500 equally and normally weighted also falling off of a cliff here and here. The ratio chart recently in 2023 has fallen off of a cliff, but the S&P 500 normally and equally weighted have not, which is incredible considering that they did fall off of a cliff the past 2 times in 20 years. So it is unclear whether they will also fall off of a cliff, giving you that 20 to 35% downward correction. We have not experienced that yet. We do know that when the ratio chart falls off of a cliff about 6 months later and then comes back up out of these doldrums, that's when the nice bull market runs. We are going to make some serious cake when that happens, because we're going to be completely long. We're not going to have so much back and forth going on. We're just going to be long the market. But we are not there yet, folks. We need to get past this portion, which is where we're at right now, which is market turmoil. All right, now we're looking at the VIX, or the volatility index, or the fear index. Now on this chart, we have three ranges. We have the ultra low range, the low range, and then the upper range. And the VIX is in candlesticks. The S&P 500 is the solid blue line. When the VIX goes down, the S&P 500 goes up. When the VIX goes up, the S&P 500 goes down. Now, we were able to recognize 2 weeks ago that the VIX was here and it looked like it was going to come down. That's when the S&P 500 did this beautiful pop. We were able to participate in that pop. So that helped us out tremendously. Now, what are we expecting? Well, the VIX is down at this ultra low level, and it looks like it wants to, on this scale here, it looks like it wants to stay here for a little while. I'm hoping that it doesn't. I'm hoping that it comes back up, because I want to be long this market, but according to this chart, it's looking like it's going to stay in this ultra low range for a little bit longer. Now we are looking at a 1-year chart of the Think or Swim trading platform with standard deviations in gold, +2, +1, -1, -2. And if you don't know about standard deviations, here's a little bit about standard deviations. And then you've got the MACD and the slow stochastics right here. Now, what do you see on this chart? We are currently at the -0.4 on the standard deviation. We have a downward sloping 50 simple moving average. That's in green. The black is the 200. This thin line that's wavy in pink, that's the 100. When you have a downward sloping 50, and that is a very negative occurrence, that's telling you that your market, the S&P 500, has troubles, because normally you are going up to sideways. Once you start traveling south, and especially once you start traveling below the 50, and the 50 is traveling negatively, as it was here, when it came up here and kissed that was the time to get out and sell. I should have taken more proactive put positions right at this failure point, but I didn't. But I sure wish that I had, and I'm definitely cognizant of that moving forward. Watching the slope of this 50 is absolutely critical. But right now we are trading above a downward sloping 50. The fact that we still have the negative slope is concerning, but the longer we spend time above this, that's going to straighten this 50 out and eventually pull it from this flattening out to this upward trajectory. That hasn't happened yet, but the more time you spend above it, that will happen. Now, one other thing to note is the standard deviations are slanting upward when you go from the left side of the chart to the right side of the chart. Just keep that mental note as we go through the next two slides. Now we're looking at a 6-month chart, but look at your standard deviations. They are flat. Basically, that's telling you that you are in a sideways trading pattern if you go and look at the time frame of 6 months. So your sells are here and your buys are here. Your buys are here, your sells are here, because the gold is your +2 and -2. Pink is +1 and -1. Where do we stand right now? We are just above the midway point at 0.3. This is that downward trajectory line, pretty close. I mean, you can move this line around depending upon whether you want to get the bodies of the candles or the wicks of the candle and stuff like that. But in essence, this is generally speaking that which was once resistance is now going to act as support. Now, we have two gaps in this chart. There's a gap here and there's a gap here. And I've got a couple of alerts that I'm going to be texted to me once we break through and touch these two touch points. I'm hoping that what we're going to do is we're going to come down, touch this support line, which coincides with this second gap, lower gap here, and then we go up from there. That's what I'm hoping for. Are we going to get it? I don't know. Right now, the market is showing signs of bullishness. We are trading above the 50. The 50 itself can act as a support. So if it tries to come down, we can bounce off the 50 and just go from there. So if that's the case, I'll just have to close out my in-the-money calls and then take on some long calls, because we're on a seasonality basis. The next 2 months are good bullish months that we want to participate in. Just was wanting to get a little bit of a pullback here. Okay, now we're looking at the same chart, but we're only going back 3 months. And on this chart, we are at the 1.7 standard deviation. So we are very, very close to the +2 on the standard deviation on a 3-month time basis. Now, I want you to notice something. Look at the angle of your standard deviations. They are not going up. They're not going flat. They are absolutely going down. Again, negative for the stock market. You have a downward sloping standard deviation trend lines. Okay? So I put in here also to show you visually sell zone and buy zone. So this buy zone coincides with that gap that I told you about. So I'm hoping that the market is going to react off of this. We have a 95% probability that it will, but that's just because you have a 95% probability doesn't mean it absolutely will. It can still continue on higher. It can break through and then come down. A lot of things can happen, but we should be towards the tail end of this positive move. We should see some sideways to downward action. If we are fortunate enough to have it come down into this buy zone, we will absolutely close out our in-the-money covered calls, take on some long calls, and on that next advance up, participate 100% long in this market. Now, we are looking at the 10-year Treasury note, and we're also looking at the blue line, which is the S&P 500. And you'll notice that when the 10-year Treasuries basically are coming down, that's when the S&P 500 is gaining momentum. But look what happened. There was a gap right here, and we've been moving sideways. The MACD histogram is showing signs that it is going to, it's already slowed its ascent, but it looks like it's going to bottom and then start to go back up. Well, if that happens, that means that the 10-year, instead of yields going down, yields are going to start going back up again, especially to fill this gap. Well, what's going to happen to the S&P 500 during that time? The S&P 500 is going to go down during that time. Hopefully, it's going to go down and coincide with what I just showed you 2 slides ago or a slide ago, how I'm expecting it to come in and fill those gaps. So this is supporting my theory that yields are going to go up on the 10-year, and the S&P 500 is going to have a slight pullback. So I have just given you a ton of information in this video. Now comes our critical thinking. What are you going to do with that information? Well, as of November 11th, 2023, the market summation, according to me, Ken, your host for Spy Trader Now, I've already told you about all of my trades. If you've been watching me, you know that basically the positions that I put on right here, those positions that I put on are still in play. I told you about my in-the-money covered calls. I've got those 2 in-the-money covered calls still in play. And I would like to buy them back after the market has come down, because when I buy them back, I'm going to buy them back for less money than when I sold them. So I'm going to pocket that cash in a downward market. It's a conservative way to take cash in a downward market without putting short positions on or without putting on puts. So that is how I'm going to try to participate in downward market movement. And basically, that is it. We just have, so from my perspective, I'm going to wait and watch and see what happens next week to make my next decisions. I hope you have gotten some valuable information out of this video. If you have not done so already, hit that subscribe button, ring that bell, smash that like button down for me right now. I thank you, and I wish you good trading.